Hi, I'm Lango, and this is InvestorPlace Quick Picks, where we communicate to you some of the market's best investment ideas in just 5 minutes. Today, I'm going to give you 3 tech stocks to buy amid this recent September tech stock sell-off. Now I get it. There are a lot of talking heads out there comparing the current run-up, the 2020 run-up in tech stocks, to the run-up they had in 2000 during the dot-com bubble. But those pessimists are just blowing hot air. Okay, the reality is the current climate for tech stocks is nothing like that of the dot-com bubble. Back then, tech stocks were trading at 50 times forward earnings. 80% above where they trade today, around 28 times forward earnings. Profit margins in the tech sector back in 2000, below 10%. Today, above 20%. The interest rates, central bank interest rates, they were at 6.5% and climbing back in 2000. Now, they're at 0% and project to stay at 0% for several years. Plus, above all else, the companies investors were bidding up to change the world back in 2000, like Pets.com, had zero chance of taking over the world. The companies we're bidding up today, Shopify, Square, Trade Desk, Roku, Alteryx, Atlassian, these companies are actually already taking over the world and have billions of dollars in revenue to prove it. So no, we are not in dot-com bubble 2.0, not at all. And the recent sell-off in tech stocks, nothing more than a buying opportunity. So with that in mind, let's look at 3 tech stocks I'm saying to buy on this dip. The first tech stock I like on this dip is Alteryx, ticker AYX. Now this is a data science company that has had a really strong growth narrative for several years, right? Because enterprises are pivoting into a world where they're using data to influence all of their decisions, from marketing to product creation. And because of that, Alteryx is at the epicenter of this, providing tools which allow these companies to analyze that data. Now the stock has fallen on hard times because amid the COVID-19 pandemic, businesses cut back on discretionary spending, and for many companies, data science was a discretionary spend item. But the economy is normalizing, business confidence is rebounding, enterprise spending is rebounding, and as these trends continue, discretionary spend on data science will come back. As it comes back, Alteryx's growth trends will rebound, the secular growth narrative will come back to life, and Alteryx stock, beaten up today, will go back to its highs from early 2020. The second tech stock I like on the dip is Vroom, ticker VRM. Now, Vroom is an all-in-one e-commerce platform for buying and selling cars. In this market, you have Carvana and Vroom. Those are the 2 biggest players. Amid the COVID-19 pandemic, the stock had a huge run-up because we were all buying and selling cars online. But now that the world is turning back to normal times, investors are selling Vroom stock on the idea that this online surge in car buying is not going to last. But it will, because the people buying cars now are young consumers. Young consumers like direct-to-consumer channels. They like the online shopping experience. So what we're seeing is a permanent acceleration in the transition towards online car buying and selling. Vroom is at the epicenter of that. So any weakness in the stock today on concerns that it won't last, those concerns are overblown. Buy the dip in Vroom stock, you have a long-term winner. The third and final tech stock to buy on the dip is PayPal, ticker PYPL. Now, much like Vroom, PayPal is getting hurt today because investors perceive COVID-19 going away as a headwind for the company, because we're not going to be in this all digital, all the time, paying for everything in e-payments mode, right? They think that we're going to start paying for things in cash again, and that's true. That is going to happen. But let's take a step back. The transition from offline to online, from physical payments to digital payments, those are secular transitions. They are going to persist long after the pandemic fades. So if the stock sells off here because Q3, Q4 growth rates are going to be slower than Q1, Q2 growth rates, oh well. Buy that dip because 2021, 2022, 2023, those numbers are going to be great. And because they're going to be great, the stock's going to keep going higher. Long-term investors are going to beat near-term traders in this name. That's just how it works. Well, that's all we have for this edition of InvestorPlace Quick Picks. I hope you like what you saw. If you did, please hit subscribe, hit that notification bell, smash the like button. And if you like to read, come and visit us over at InvestorPlace.com, where we have some of the market's best analysis. Until next time, cheers and happy investing to all.